8 Best Cashback Credit Cards for 2026. Strategic Deep Dive. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. What I am sharing today is the institutional-grade framework that top-tier wealth management firms and family offices charge thousands in annual retainers to implement. If you are taking notes, you are already ahead of 90% of market participants who view credit as a consumer trap rather than a sophisticated financial instrument. Most individuals treat cash back as a minor rebate on lifestyle spending. But for the high-net-worth individual or business executive, these tools represent a primary lever for capital efficiency and liability architecture. By the end of this deep dive, you will have mastered 3 specific outcomes. First, you will understand how to utilize 2026 top-tier cashback instruments as a zero-cost liquidity buffer that enhances your net interest margin. Second, you will be able to synchronize your credit utilization with IRS Section 179 and the 2026 bonus depreciation rules to optimize tax timing. Third, you will learn to structure your personal and corporate liabilities to minimize your weighted average cost of capital while maximizing your AdSense equivalent returns on every dollar of operational spend. To understand the 8 best cashback credit cards for 2026, we must first abandon the coupon clipper mindset and adopt a capital allocation perspective. In the current economic landscape, where the Federal Reserve's long-term pivot has stabilized but inflation remains a structural factor, cashback is not a discount. It is a tax-free yield. Historically, when we analyze the velocity of money within a business or a high-spend household, the delay between a purchase and the settlement of that debt, known as the float period, is a period of immense opportunity. By selecting instruments that offer high-percentage cash rewards alongside extended 0% introductory APR windows, you are effectively securing an interest-free loan from the bank while being paid to borrow their capital. In 2026, the primary objective for any sophisticated borrower is the optimization of the cost of capital. When you utilize a card like the Wells Fargo Active Cash or the Citi Double Cash, you are looking at a flat rate base of 2% liquidity return. While this sounds modest, when viewed as an institutional asset, it represents a risk-free, post-tax return that often exceeds the yield of short-term treasury bills. For an executive in the 37% tax bracket, a 2% tax-free reward is equivalent to a 3.17% taxable yield. This is where the separation of personal and business liabilities becomes critical. By utilizing specialized business instruments like the Capital One Spark Cash Plus or the Inc. Business Premier, you are not just earning rewards. You are creating a firewall between your personal credit profile and your commercial operational expenses. One of the most potent strategies for 2026 involves the intersection of credit and the Internal Revenue Service's updated guidelines. Under the current tax code, the Section 179 deduction limit has been adjusted for inflation to roughly $2.56 million. For business owners, this means you can deduct the full purchase price of qualifying equipment, ranging from enterprise software to fleet vehicles, in the year it is placed in service. When you finance these acquisitions through a high-yield cashback instrument, you are layering rewards on top of an immediate tax shield. If you use a 2% cashback card to purchase $100,000 of qualifying equipment, you receive $2,000 in tax-free liquidity while simultaneously reducing your taxable income by the full $100,000. This is the definition of capital efficiency: using the bank's money to lower your tax liability and getting paid for the privilege. We must also address the global bridge for our international viewers in the United Kingdom, Canada, and Australia. While the regulatory environments for interchange fees differ, meaning UK and EU cards often have lower headline reward rates. The strategic framework remains identical. In Canada, utilizing GST/HST input tax credits in conjunction with corporate rewards cards provides a similar dual benefit structure. In the UK, the focus shifts towards Section 75 protection under the Consumer Credit Act, which acts as a risk mitigation framework that no cash or debit transaction can match. Regardless of geography, the goal is to maximize the interest-free float. By timing your large expenditures at the beginning of a billing cycle, you can often push the actual cash outflow 50 to 60 days into the future. In a high-interest environment, holding that cash in a liquid money market fund or high-yield savings account for those 60 days adds an extra layer of synthetic cash back to your bottom line. As we move deeper into this analysis, we need to talk about utilization ratios and their impact on your future borrowing capacity. Institutional lenders in 2026 are increasingly using AI-driven underwriting that looks beyond the simple FICO score. They are looking at trended data, your behavior over the last 24 months. If you are constantly maxing out your cashback cards to chase rewards, you may inadvertently signal liquidity stress to the algorithm, even if you pay in full every month. The strategy here is capacity expansion. By maintaining a total aggregate credit limit that is 10 to 20 times your average monthly spend, you keep your utilization in the low single digits. This ensures that when you need to access asset-based lending or a large commercial mortgage, your credit health is pristine, allowing you to secure the lowest possible rates. Safety and risk mitigation are the pillars of institutional wealth. Every credit card transaction you make is technically a non-recourse event for your actual bank balance until you authorize the payment. This means if a vendor fails to deliver or a fraudulent charge occurs, you are disputing the bank's money, not your own. In 2026, as cybersecurity threats evolve, this buffer layer is essential for protecting your primary capital reserves. Furthermore, for those managing multinational operations, utilizing cards with no foreign transaction fees is a basic but essential cost reduction strategy. Whether you are dealing in USD, CAD, or GBP, every percentage point saved on currency conversion is a direct addition to your net profit margin. Finally, let us consider the cost of capital analysis. When you evaluate a card like the American Express Blue Cash Preferred or the Chase Freedom Unlimited, you aren't just looking at the 6% or 3% categories. You are looking at the opportunity cost. If you have $50,000 in a business account earning 5% interest, and you spend $50,000 on a card with a 0% intro period, you are essentially earning $2,500 in interest on your own cash plus whatever rewards the card provides. This double-dipping strategy is how sophisticated investors manage their cash positions. It allows you to maintain high levels of dry powder for investment opportunities while using the bank's balance sheet for your daily operations. Always consult with a qualified financial advisor or tax professional to ensure these strategies align with your specific entity structure and local laws. This brings us to the integration of rewards into your overall wealth strategy. In many cases, high-spend executives overlook the compounding effect of these rewards when reinvested. If you are generating $10,000 annually in cash back from corporate expenditures, reinvesting that amount into a diversified portfolio with an 8% expected return results in over $150,000 in additional wealth over a decade. This is no longer a perk. It is a distinct asset class. For 2026, we are seeing a shift toward customized tiering, where cards like the Bank of America Preferred Rewards program offer multipliers based on your total assets under management. This creates a synergy between your banking relationships and your spending efficiency. If you maintain significant liquidity within their ecosystem, your base cashback rate can climb to levels that rival institutional rebates typically reserved for Fortune 500 companies. This level of integration is what separates the casual user from the sophisticated wealth builder. You are essentially negotiating your own interchange rates by leveraging your deposits. Furthermore, you must consider the reporting lag. There is historically a 30-day window before your credit report reflects your new balances. Strategic spenders use this window to execute large capital allocations just after a statement closes, ensuring that their reported utilization remains low even during periods of heavy commercial acquisition. This is a vital component of the liquidity management playbook. By the time the balance is reported, the cash is already allocated to pay it off, keeping your score elevated. As we analyze the best instruments for 2026, we must prioritize those with robust API integration. For business owners, the ability to feed transaction data directly into accounting software like QuickBooks or Xero reduces administrative overhead. This reduction in soft costs is another layer of the capital efficiency framework. Every hour saved on manual reconciliation is an hour spent on high-value revenue generation. Therefore, the best cards are not just the ones with the highest percentages, but those with the most efficient data architecture. This brings us to the concept of strategic spend shifting. Historically, individuals wait for a purchase to be necessary before applying for a new instrument. The institutional approach is to have the capacity ready before the need arises. By securing high-limit cash-back cards during periods of peak liquidity, you ensure the tools are available when you need to execute a rapid Section 179 acquisition. We are also seeing 2026 bring an increase in purchase protection limits. For executives purchasing high-end hardware or office equipment, the secondary insurance provided by premium cash-back cards acts as a risk transfer mechanism. This effectively lowers your insurance premiums on specialized assets, further optimizing your cost basis. When we look at the global landscape, the USD dominance in reward structures remains a key advantage for US-based entities. However, by using global bridge strategies, UK and Canadian investors can still achieve high-teen internal rates of return on their spend by focusing on flat-rate business cards that offer simplicity and scale. In every case, the underlying mechanics remain the same. Use the credit card as a high-frequency clearinghouse for all operational expenditures to capture every fraction of a cent in margin. This is how you build a six-figure AdSense business or a multi-million-dollar portfolio, by winning the war of margins. Before we end, let me summarize the vital and critical information we have covered today. To truly leverage the 8 best cash-back credit cards for 2026, you must look beyond the rewards and see the underlying financial architecture. Treat cashback as a tax-free yield. In high tax brackets, a 2% reward is statistically superior to a 3.17% taxable investment return. Leverage the float. Maximize the 50 to 60-day interest-free period between purchase and payment to keep your capital working in high-yield environments. Synchronize with tax codes. Use credit instruments to facilitate large, deductible purchases under IRS Section 179 to maximize immediate tax shields. Prioritize liability separation. Keep personal and business expenses strictly divided to protect your credit profile and simplify institutional audits. Manage utilization for future access. Maintain high credit limits relative to spend to ensure you remain an A-paper borrower for future asset-based lending. Automate data architecture. Select cards with high API compatibility to lower operational soft costs and focus on revenue-generating activities. Subscribe for more institutional-grade analysis on capital allocation and wealth strategy. Like this video if it changed your perspective on how to view credit as a liquidity tool, and comment below with your specific questions on entity structuring. Disclaimer: this content is for educational purposes only and does not constitute financial, tax, or investment advice. Consult with qualified professionals before making financial decisions.